guys, this is Justin from iFlyer Options. Here at HFO, we are trying to create a community of like-minded traders. Traditionally, we make our profits off of options trades, but our subscribers have spoken, and now we will be sending out trade alerts in stocks and ETFs, as well as our options trades. We are active traders here at HFO, and we want to explore all the options to make us and our subscribers profit. Going forward, we will be publishing all of our trades in these areas as we make them to our subscribers, because we always want our subscribers to have more options in the market. This last week was pretty volatile, and I'm going to go over one of our trades that got hard hit by some news, which is what you always got to watch for, which is going to be LinkedIn, LNKD. We got in right about here, and it was looking really good, to be honest. It was looking like a good trade, and we got in on Tuesday, and then we got out at a loss on Thursday the 3rd because of a data breach that happened that day, and there are already lawsuits being filed against them, and they're looking at liability in the billions. So that caused the stock to go into a free fall on Thursday and Friday. After the trade went against us, we entered a vertical spread trade on LNKD. As I said, spreads are good for very volatile stocks. And as of Friday's close, we are up 13% on that, and we have more than made up our lost investment. Okay, so here's the weekly HFO watch list for the upcoming week. It's going to be FAS, which is Direction Daily Financial Bull 3X Shares. VXX, which is going to be iPath S&P 500, VIX Futures ETN. YNDX, which is going to be Yandex NV, and TRLA, which is going to be Trulia. Okay, and now for the HFO strategy of the week, we're going to be going over spreads. And spreads are a good strategy to use in very volatile markets. And the two most commonly used spreads are going to be the straddle and the strangle. Okay, so before I get into straddles and strangles, just a real quick exercise so y'all can follow along pretty well. Just some kind of market lingo. It's kind of its own language, so you'll get used to it definitely. But let's take a stock, and it is trading currently at $10. That is considered at the money. And anything above that price, and this is the strike price, this is what it's trading at. Anything above that price, which would say just if it traded in $1 increments, say $11, that would be out of the money. Anything over the strike price. And then the opposite would be in the money, which would be anything below the strike price of 10. So a price like $9 would be in the money. Okay, so now on to straddles and strangles. A straddle, straddles and strangles are both going to be a two-legged trade, which is going to be a call and a put. And like I said, they go great with volatility. Because basically the whole concept of them is you're hedging your bet per se. You're buying a call and a put, so whichever way it moves, the leg that it moves to is going to give you more profit than the other leg. So basically you subtract the profit that you make on the leg that it moves towards from the leg that wasn't doing anything, but it was your insurance. So this is for more conservative traders, I would say. And for a straddle, you're going to buy a midterm, which is the expiration period from 2 to 5 months, and you're going to be buying it at the money call, which we just went over. And then also at the same time, you're going to be buying a midterm, and whichever one you picked from the 2 to 5 months out, you're going to pick one with that same month of expiration date at the money put. So you have a call and a put both at the money. And markets should be, like I said, in massive consolidation or extreme volatility. Consolidation is basically if it's just going straight to the side, it's not doing anything, you just need to pull some money out of the market. Or if it's extremely volatile, you don't really know which way it's going to go. So you do a straddle or a strangle just to say, well, I know it's going to move some way, and I want to make money off of it. And the kind of the criteria for a straddle is going to be over $25. A good thing to place a straddle or a strangle is going to be before a news or earnings date. Say like the LNKD, the LinkedIn trade. If we would have known that news was going to happen, if it was going to drop so much, you would have liked a straddle just because even you know it's going to drop, so you put in a straddle, you have that insurance, or earnings can drive a stock way up if they're good earnings, or way down if they didn't meet the earnings that everyone was expecting. And on the flip side, a strangle is going to be pretty similar to a straddle, but it differs in the sense that it's still a call and a put, but as opposed to trying to get the two legs as close to the money as you can at the money, with a strangle you're going to be buying the call and the put out of the money. And we went over out of the money. It's going to be above the call and the put, and it's going to be the very next strike price. The very next strike price would be the one directly above the at the money, what it's trading at. And these are both spreads. These are probably the two most traded spreads. And just to give you all the different kinds, because we're just giving you a broad overview of this. A vertical spread is when two option legs with the same expiration date, and both of those would be vertical just because we're doing those all in the same month. And a horizontal would be two options with the same strike price, different expiration dates, which we haven't gone over yet. And lastly, a diagonal spread, which would be different strike prices and different expirations. And something really important that you got to pay attention to on spreads is going to be the beta, which is it's a Greek, and if you're not familiar with Greeks, it's basically a list of different numbers that very smart people came up with an algorithm, and it's basically they're indicators of certain things in stocks. So the beta is going to be the measure of volatility. You can see this on FinViz or any other major chart online. You can pretty much find the beta anywhere. And a beta of 1 is basically saying that the stock will move with the market. The market goes up, the stock's probably going to go up. Beta of 1.4, with a market move, this stock is expected to move 40% more than the market. And of course, as you've guessed, a beta of 2, which is what we're shooting for, is the stock is going to move 100% more than the market is moving. And that's where you see your doubles and triple of returns, because you know if this stock moves, it's going to move big. And volatility is going to be key in options trading, just because that's where we make our money, is these stocks moving. And we only trade straddles and strangles with a beta of 2 or greater. So that's going to be straddles and strangles for this week. That's all we have for you this time here at High Flyer Options. As always, good luck out there in the market.